Welcome to The Explainer. Today, we are unpacking a corporate metamorphosis of literally unprecedented scale. We're talking about the total ground-up transformation of Reliance Industries Limited. So, let's dive right into this.
Now, I know it sounds almost absurd to even ask, right? But it is the defining question of India's current market. Is India's biggest oil company no longer an oil company? It's a massive shift in how we all have to view this traditional powerhouse, and honestly, it challenges everything we thought we knew about their core business model.
Just to wrap our heads around the unfathomable scale we're dealing with here, take a look at their annual revenue for the recent fiscal reporting, 11.76 lakh crore rupees. To put that staggering figure into perspective, they added nearly 3.87 lakh crore in additional revenue in just 5 years. Think about that for a second. We're looking at an empire that is essentially bolting entire conglomerates' worth of value onto its top line in a matter of just a few dozen months. It's wild.
Okay, so here's our roadmap to untangle this complex web today. We're going to cover 1. Beyond the oil business, 2. The massive capex gamble, 3. Jio's 2026 mega IPO, 4. Funding the green transition, and finally, 5. Is a re-rating coming? Let's start right at the top with Section 1. Beyond the oil business.
So there is this stark night and day contrast between the old Reliance and the new one. Historically, the company was highly cyclical. It was focused almost entirely on hydrocarbons and really heavily dependent on global vendors. But the new Reliance, it flips that script entirely. It's being built on sticky, recurring subscription revenue, deep tech development, and total ecosystem dominance across both physical and digital spaces. And why does this matter to us? Well, because the market pays a massive premium for predictability. Recurring digital revenue is simply valued way, way higher than the boom and bust cycle of global commodities.
And you know what's really interesting? The market has actually already caught on to this shift. If you look at their enterprise value, telecom and retail now make up over 65% of the total. Meanwhile, oil to chemicals, which was historically their absolute anchor, has structurally shrunk to just 22%. They are already being priced as a modern digital conglomerate, not a legacy refining giant. So, in the eyes of the market, this transformation is already well underway.
Which brings us to Section 2, the massive capex gamble.
Because, let's be real, this kind of rapid corporate expansion doesn't just happen by magic. Recent financial snapshots, like these Q4 estimates from MK, reveal a real squeeze on their traditional cash cow. Earnings in the oil to chemicals, or O2C segment, have definitely weakened. Management actually noted that Middle East conflicts driving up crude premiums, global supply chain disruptions, and higher freight costs are heavily impacting these legacy operations. They're really feeling the squeeze of global volatility, and this pressure builds right into
a frankly staggering capital expenditure bill. Over a 5-year period, Reliance's capex sits at 6.9 lakh crore rupees. Building the modern, tech-forward conglomerate we were just talking about comes at an astronomically high cost. We are watching one of the most aggressive corporate reinvestment cycles anywhere in the world right now.
Now, because of this ultra-aggressive spending, their return on capital employed, or ROCE, has taken a pretty significant hit. It dropped from 20.6% down to roughly 11%. But honestly, this makes sense. When you pour billions into ground-up infrastructure, whether we're talking nationwide 5G networks or massive manufacturing plants, you just don't see those returns overnight. Billions are being poured into businesses that are still maturing, which inevitably causes these short-term dips in capital efficiency. It's a calculated waiting game for them.
But here's the thing. All that heavy lifting is absolutely paying off in intellectual property. Jio Platforms recently made a massive 320-spot jump to enter the WIPO Top 20 global patent rankings. That's huge. They aren't just buying tech anymore. They're actually building it. We're talking proprietary 5G and 6G, cloud-native networks, and their JioBrain AI platform, which is designed to take intelligent, autonomous actions. They are successfully transitioning from being completely vendor-dependent to becoming a true deep tech creator.
Moving right along to Section 3, Jio's 2026 mega IPO.
All of this digital infrastructure we just covered is paving the way for what could easily be the defining market event of the decade. Targeted for the first half of 2026, the expected IPO valuation for Jio sits between 10 to 12 lakh crore rupees. That's roughly $120 to $150 billion. Even if they float just 2.5 to 5% of their equity, it would potentially make this India's largest public listing to date, completely reshaping the indices.
And the underlying metrics absolutely justify the hype. Jio currently commands an unmatched scale of 524 million users. But here is the most fascinating part. Right now, about 45% of their 5G data traffic is totally free. Yet, despite that, their average revenue per user is still rising, recently hitting 206 rupees. The massive cash flow potential here is just waiting to be unlocked by transitioning that free traffic into paying customers through upcoming tariff hikes. That is pure, highly profitable recurring revenue.
Okay, so the digital future is bright, but let's look at the physical world. In Section 4, Funding the Green Transition.
The urgency of this pivot is actually best summarized by the management themselves. They've openly stated that the outlook remains extremely vulnerable to geopolitical risks amid the Middle East conflicts. They know firsthand that the global oil market is simply too volatile and totally outside of their control. So pivoting away from this legacy dependence, it isn't just a nice nod to environmental sustainability, it is an absolute imperative for their long-term corporate survival.
And they are moving incredibly swiftly from investment to reality. Step 1, their 40 gigawatt-hour lithium iron phosphate, or LFP, battery gigafactory is scaling up production through late 2026. Step 2, an electrolyzer gigafactory will come online by the end of 2026 to help generate clean power. And Step 3, they're building towards producing 3 million metric tons per annum of green hydrogen by 2032. This is exactly the industrial scale required to entirely reimagine a country's energy infrastructure.
Which finally brings us to Section 5, is a re-rating coming?
With all these moving parts, the intense capex, the deep tech creation, the green energy pivot, we have to ask what's next for the stock. Morgan Stanley actually maps out a very concrete timeline of catalysts for 2026. Q1 anticipates a cyclical upswing in legacy refining. Q2 brings that crucial Jio revenue hike we just discussed. Q3 is the big one, the potential digital IPO and the scaling of those new energy gigafactories. And finally, Q4 expects a steady recovery in the chemical sector. It's a year literally packed with potential value unlocks.
Because of all these upcoming catalysts, the institutional consensus right now definitely leans bullish. Jefferies and Motilal Oswal both maintain buy ratings with a 1,750 rupee target, while Morgan Stanley is overweight with an 1,847 rupee target. That represents up to a 26% potential upside from current levels. But of course, as informed viewers, we have to constantly balance this optimism against the very real capital execution risks and those short-term efficiency dips we unpacked earlier. It's a brilliantly complex picture. Which leaves us with one incredibly powerful final question. Will Reliance successfully dominate India's digital future as a platform supermajor, or could it buckle under the intense capital weight of its own expansion? It's a high-stakes gamble that is absolutely going to define the next decade of Indian business. Thank you so much for joining this explainer. Keep analyzing, keep questioning, and we'll see you next time.